Good afternoon, advisors. Welcome to our 2015 webinar series. This year we'll focus on a family, the Greens, all 4 generations of them. And as with any family, there's drama. They're bold and beautiful. They're young and restless. We'll paint their portrait of risk and look at ways to protect the family and the family business. How will we do it? With insurance solutions tailored to meet their needs as they travel through the days of their lives. They all have just one life to live, but that life will be filled with glee at times and with passions at others. But through it all and across the generations, they have a guiding light, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. Each month's series will last about 50 minutes. The narrators of these hour-long series know that you'll have burning questions, and since these are performed in front of a live audience, feel free to be interactive. Type in your questions and we'll do our best to answer them timely or at the conclusion of the show. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. And throughout 2015, loyal fans will receive 10 CFP CE credits, 1 for each month. The more you tune in, the more you know. Today's narrator constantly monitors the insurance and financial services industries to continue building the LLIS dynasty. He joined the LLIS cast in 2003 with his CFP and MBA and has been our executive producer as president and CEO since 2013. He's brought our ratings up with membership in the National Association of Insurance and Financial Advisors and speaking engagements at NAPFA, ACP, Garrett Planning Network, and other organizations seeking insurance-related education. And he keeps the drama down by asking for full transparency from our advisors and clients. No secrets and lies. And now to introduce our characters is our own character, Mark Maurer.
Thank you, Dina. That's the first time I've heard that, and that was fantastic. I'm kind of glad you can't see me because you would have seen me just sitting here giggling. And oh, that was good. So I have a lot to live up to, and I will do my best. So today we kick off our 2015 webinar series with meeting your clients. And one more second. This was going to be really good. There we go. And so like any good drama, any good soap opera, we have multi-generations of people. We have one large family. I think it was Dallas, where you had the one family, and this person was married to that person, and they had these kids, and that person was with this person. We have our Greens. They're a little more wholesome than the people from Dallas or many of the other, the stories, as my grandma called them. But we have the Greens, and for our 2015 webinars, these are going to be your clients, the Green family, 4 generations of them, as they move through the phases of life with different financial needs as they seek to protect against uncertainties and deal with upturns and downturns. And they're a pretty cool family, actually, and let's get to know them a little bit better. And so to help keep people in, keep everybody in your minds, keep them there, we have the A's, the B's, the C's, and the D's. It's kind of a neat little thing. So our first generation, Andrew, with the A, he's the patriarch whose wife Julia died from a long bout with Alzheimer's disease 3 years ago. And for Andrew, these are all his children, even though they may have married into the family, they are all his children. And we have the second generation, his kids, the B's, Barbara, who's a retired yoga teacher, and Ben, who's a small business owner. And Ben is married to Mary. And anyone whose name doesn't start with an A, B, C, or D, married into the family. And the third generation, Barbara's kids are Claire, who's married to Tony, an IT consultant, and Cameron, who has Down syndrome and lives in an adult living facility. He had just moved there, and they didn't want to interrupt his new routine, so he's not in the group family picture. And Ben and Mary have Carl, who is married to Jenny. Carl's in the family business with his dad, and Jenny's a school teacher. And lastly, we have the fourth generation. Claire and Tony, between them, they have 3 kids. Deidre from Claire's first marriage, and David and Daniel from Tony's first marriage. And Diana is Carl and Jenny's daughter. There they go through the generations. So which of the greens are your clients? We hear from financial advisors all the time that one of their biggest concerns is figuring out how to keep the next generation as clients. Remember, the children and grandchildren of your clients are today's modern families. What does that mean? Well, the first step in retaining these modern families is to realize that each client has a unique situation and requires a financial plan and insurance solutions tailored to the complexities of their family. Because today's modern family isn't what it was 20 years ago. And we're going to talk about the modern family and what some of the different dynamics are. Our American family was formerly defined as mom, dad, kids, and today, untraditional is the new traditional. And modern American families come in many shapes and sizes. Traditional families are fewer than 20% of households today, and that's down from 40% in 1970. And when I heard that, it seemed kind of high, kind of low to me. I thought, that seems like a lot. Well, I come from a traditional family. Mom, dad, 2 boys, 1 dog, 2 grumpy cats. I mean, everything you would expect, especially about the cats. And then I have a traditional family, myself, my wife, my 2 children, an old dog, no cats. But then I look at my brother, and he is a permanent resident in Germany, living with his longtime girlfriend, and they have a dog too. And then I looked at my cousins. I don't believe any of them are on their first marriages. Some are remarried, some are divorced, some have adopted, some haven't. So when I started looking at just the first 1 or 2 layers around me, I realized that, yeah, actually I think in our family, probably less than 20% are a traditional family today. And so that number, when I looked at it first, surprised me, but then when I actually did the real math, it sounds about right. Families are multi-generational. Lots of single parents, unmarried and or same-sex couples, blended families, older parents with young children, boomerang families. And this is when somebody moves out, goes away to college, all of a sudden they come back and have a kid in tow, and now decide to live back with mom and dad. So all of these are it says, untraditional is the new traditional. 80% of people who walk in your door may fit any one of these. It's the mom, dad, 2 kids, 2 grumpy cats that really isn't the norm today. And modern families report, more often than the quote-unquote traditional families, that they have unexpectedly lost a main source of income. They've declared bankruptcy and or needed short-term or long-term disability in larger percentages than the so-called traditional families. They feel financially disconnected. They have the same strong emotional ties to each other, but often feel financially less secure than their traditional counterparts. And here are some statistics from an Allianz study about the modern family. Fewer of them feel secure in their finances compared to traditional families. But in larger percentages, they've collected unemployment, lost that source of income, or declared bankruptcy, almost double declaring bankruptcy than a traditional family. And modern families also struggle with their financial futures. Less of them believe they have excellent or above average financial planning knowledge or expertise, and less of them believe they're on track to achieve their financial goals than traditional families. And they are open and encouraging. As you can see, they openly talk to their children about their personal financial situations more often than traditionals. Actively encourage their children to invest more often than traditional families. And this just may be something that because they've struggled with it, they are more likely to share with their children. But they are less willing to seek help. Fewer modern families have consulted a financial professional than their traditional families, and more of them don't believe they make enough money to think about financial planning and or just have too many expenses and day-to-day things to worry about planning for the future. But modern families have other unique factors impacting how they approach and think about financial planning, and they want you. They don't know, maybe they don't know that they want you, maybe they don't know that they need you yet, but as an industry, you have a historic opportunity to help guide Americans on a path to financial security. So now that we've discussed the modern family, let's look at our modern family. And we will start at the top with our patriarch, Andrew. He's a widower, been retired for a number of years from his job as a senior executive in the food industry. His estate is worth currently about $12 million. Much of it is in qualified retirement accounts, which he's starting to take distributions from. These accounts are unlikely to be depleted during his life and will give rise to both income and, under today's estate tax regime, estate taxes at his death. So our April webinar is going to look at Andrew and leaving a public and private legacy. And this webinar addresses the estate planning module of the CFP planning, with talking about uses of life insurance in estate planning, gifting strategies, estate planning for non-traditional relationships, and it touches on some of the income tax planning module with charitable contributions and deductions. Andrew's goal is to leave a lasting impression on his family and his community. And one of the ways that he wants to do that is with life insurance. And life insurance can be structured with favorable tax benefits. It can be structured with favorable distribution benefits to the beneficiaries. And we're going to touch on how life insurance as a way to pass wealth on to someone or something has a good to great rate of return at death. One of the things we're going to look at is the ownership of the life insurance policies. So what are some pluses and minuses to having Andrew own the policy by himself? Well, the downside, of course, is that the death benefit at his death is included in his taxable estate. That's a bad. I could put a frowny face right next to that. But a smiley face on the other, right below it, is that he retains complete control to make changes. That's always a plus. Probably the second thing, or even the first thing we might think of knowing that his estate is worth $12 million, is to have the life insurance owned by an irrevocable life insurance trust, or an ILIT. And an ILIT is a separate entity. It has its own tax ID number, and when the policy is owned by the ILIT, the beneficiary is the ILIT, the death benefit is excluded from his taxable estate. Smiley face. The trustee controls the trust. So now Andrew, while he may pick the trustee, the trustee's responsibilities are not to Andrew, but to the beneficiaries of the trust. In this case, we'll assume it's his kids and grandchildren. And Andrew makes annual gifts, or may make a one-time gift, or he may make the annual gifts under the annual gift exemption. Now, an option that is like an ILIT but doesn't require attorneys to draft a trust, the monitoring of crummy letters every year, is to have the life insurance policies owned by his children. Well, another smiley face, still excluded from his taxable estate, and Andrew makes gifts to the children instead of to the trust, same way he would, but the kids control the policies. And once the Ben and Barbara control the policies, they can make the beneficiaries whoever they might want. And so that's something that Andrew needs to think about. Are Ben and Barbara responsible enough to have that responsibility? Because we look at the beneficiaries. If the beneficiaries are the children and Andrew dies, Barbara and Ben have unfettered access to the cash. If it's $1 million, they can take that $1 million policy and, as Jerry says, go to Vegas, put it all on black, and either have $2 million or zero. With an ILIT, the trustee, being that independent person, gets to distribute the death benefit of the life insurance policy per the trust parameters. And so Andrew can set this up however he wants. He can set it up for MESH or HEMS, for all of you who studied for the CFP exam, maintenance, education, support, health. Or he can throw in things like when one of the kids, I always forget the names, of Carl, when Carl gets his master's degree, he gets $50,000. And if Deidre marries somebody with a name that starts with M, she doesn't get anything. So he really can control from beyond the grave with the trust. But beyond some sort of wacky things, the trust really does protect that cash value, or the death benefit and the money in there in the trust, and it protects the beneficiaries of the trust from creditors, predators, and divorce. Now, Andrew may also have charitable intentions, and there can be a life insurance policy owned by the charity, or the charity is the owner and beneficiary. And Andrew gets a current deduction for the premiums to the charity. So that's what he gets there. If the life insurance policy is owned by Andrew, Andrew owns it, but the charity is the beneficiary. A plus here is that Andrew can change. A charity is never going to change its beneficiary away from itself. And if Andrew all of a sudden wanted the charity to be the University of Florida and didn't like the new coach, he can change it to somebody else. Can't do that if the policy is owned by the charity. And Andrew's estate gets a deduction it only gets a deduction at death in the amount of the death benefit. So a much larger deduction, but he doesn't get to deduct the premiums in the policy because he owns it. But he should be able to contact the boosters, his church, his synagogue, and get a deferred gift recognition. And this is usually a plaque somewhere that he gets a notice that he is planning on giving that place $1 million at his death. And you sort of get some extra utils for a big number like that, even though it may not be today. So we move away from Andrew and move now to our second generation. And Ben is the first one of the second generation that we start looking at. Ben and Mary are married. They're both in good health and have the one son, Carl. Ben owns a successful manufacturing business, and he's transitioning the business in 10 years to Carl. They have a modest estate, but limited retirement funds. Like a lot of business owners, and especially someone in the manufacturing business, a lot of money is going back into the business, into inventory. So the business is his largest asset by far. So they have limited retirement funds, but the business provides good cash flow for now. And in May, we're going to talk about how to speed up protection when your clients start thinking about retirement, even though they've gotten a late start. Because Ben's been focused on his business and not retirement. And so he's going to be transitioning from the idea of transitioning from earning to spending. We worry so long about wealth accumulation, we're getting to the point where we're now starting to think about depleting it and using it when we're not working anymore. In May's webinar, we'll cover the insurance planning principal topic of the CFP courses with long-term care insurance, insurance needs analysis, business uses of insurance, and annuities. And we'll touch on some of the retirement planning principal topic with investment considerations for retirement plans and retirement needs analysis. So we're moving from earning to spending. So they've built up their nest egg. how do we ensure that clients don't spend down that nest egg if they need long-term care in the future? And with costs being estimated at $700,000 per person, if someone needs 3 years of care in 20 years, how do we protect clients' portfolios? Well, traditional long-term care insurance is a great way to protect that portfolio if someone needs care for an extended period of time. Now, there may be some nice tax benefits for small businesses who purchase or pay for long-term care policies, and especially a C Corp. With a C Corp, the premiums are fully deductible to the employer. That's a smiley face. Premiums are not taxable to the employee. Smiley face again. Benefits still receive tax-free. Third smiley face. This one might be even bigger because how often do you get 3 smiley faces? And you get to pick and choose who to cover. A 4th smiley face. So long-term care insurance for C Corps is sort of kind of like when the estate tax went up to $10 million. Nobody really saw it coming, and there's just all sort of good parts to it. So having a C Corp get the long-term care coverage on an employee or, more than likely, the owner is a fantastic tax benefit. And let's look at shared care policies for partners. They can be unmarried partners, but a shared care rider of a long-term care policy creates a pool of benefits that allows each partner to have access to the other's benefits in the case that one partner exhausts his or her benefits and needs care longer than, say, their 3 or 4 years of the policy. They can start dipping into the other partner's pool. There's another good pun, dipping into the other person's pool. A neat part about this is that when one partner dies, that part's not neat, but with the policy, when one partner dies, the survivor gets to keep his or her benefits, any unused benefits from the spouse's policy, and the premiums revert to just what the survivor's premiums would be. So they get more coverage, premium goes down at the first death. And so that's a nice plus of a traditional long-term care policy. But then there may be times to consider a hybrid life insurance or long-term care policy for clients. And with this, it's a hybrid policy, a combined policy, sometimes called ABC or asset-based care, that can provide clients with life and long-term care coverage combined into one policy. The most traditional policies have minimal life insurance and long-term care benefits that look like a traditional long-term care policy. And most of these policies are designed to be paid up in 10 years or less, meaning some companies only have a single premium on this policy today, and others that have a more annual premium cap it off in 10 years. But still creates cash values, life insurance, but then long-term care in much larger proportion. And it's a tax-free death benefit if they don't use it at all on long-term care. So if the client or the insured never needs it for long-term care and dies, there's a tax-free death benefit to a beneficiary. If at some point they decide they don't need it, these policies are designed to have a guaranteed full or partial return of premium if their needs or plans change substantially. So there's a long-term care pool if they need long-term care. There's a death benefit that passes on to beneficiaries if they die without needing the long-term care, or if they needs drastically change, then there is often 80 to 100% return of premium of the premiums paid after the policy's been in force. So another way to get out of the policy. So which option is correct? Well, it depends on the client, and it depends on things like their cash flow, what assets they might have, the different needs. Do they worry about a death benefit or having a cash value, or are they worried about running out of money? Do they have legacy goals where the life insurance component is important or not? Assets, do they have already an existing life insurance policy with cash values that could be used in a 1035 exchange into a new hybrid policy. So all of those are things that depend on the client, the need, and which type of policy may fit best. We look at our other part of our second generation, and Barbara. Barbara is age 57. She has 2 children, Claire and Cameron, and she's separated and involved with several local community and arts organizations. But she has limited assets, and Andrew has been helping her with additional income since her husband left. Now in June, we're going to touch on how to keep your clients from running out of money. One of the ways to look at that is to have a guaranteed income using immediate annuities during her retirement years. And where we said that she may have limited resources, Andrew doesn't. So Andrew may be able to purchase annuities or immediate annuities for her to help out. And Barbara was the one who provided care for her mother, Andrew's wife, for years before her death. So she really sees the need for long-term care coverage. Because who is going to take care of her? It may be her children, and she doesn't want to be that burden on her children that her mother probably felt that she was to Barbara. And we look at nest egg protection with the long-term care insurance and or hybrid annuities. And just in case we have those care needs, again, ways to prevent clients from running out of money. In this webinar, we'll cover the CFP insurance planning principle topic, covering long-term care insurance, insurance needs analysis, and annuities. Try saying insurance needs analysis 5 times fast. Whew. So Barbara is going to have a guaranteed income. And retirees with a guaranteed income stream are far more confident about their finances. And they are also they're happier too because they have a guaranteed income stream. And this is from a Time study. The retirees with a traditional pension are more content than those with the same level of wealth but no pension. And retirees who have both a pension and a 401k are even happier. Now, that just makes sense to me as someone who likes knowing what my budget is, what my income is going to be every month. I think having that annuity, that income stream that I know exactly what it's going to be, creates that. So an immediate annuity can be that, you may see it called a private pension. But immediate annuities will do that because you know that the client can't outlive that income stream. Now looking at Barbara, we have other considerations as well because she's a single female. And 80% of single females die alone. And this is nothing other than the fact that women live longer than men. And the average age of a widow is 59. And even though I've heard this a couple of times, that still surprises me as well. But the fact that women outnumber men in nursing homes 4-to-1, just because of what we do, and we look at how female rates are lower than men for life insurance, and we know that women are going to outlive men. And so they outnumber men in nursing homes 4-to-1. All of those things have contributed to most insurance companies increasing premiums on traditional long-term care policies for single women. Why? Well, if you're alone, you will probably use your policy faster and more often and to a larger amount than if you have a spouse, a partner to help care for you. And because women outnumber men in nursing homes 4-to-1, it's much more likely that a woman is going to use their long-term care policy than a man. And so insurance companies had unisex rates for many years on traditional long-term care policies, and recently, probably in the last year or two, have repriced for single women. So why do we want to talk about long-term care insurance for Barbara now, but almost anyone for now? Well, one, get it while you're younger. Rates are lower when you're younger. I think rates for almost everything are lower when you're younger, except probably when you're 16 and you're driving. That one, younger, isn't good. But let's say beyond 25, most things are less when you're younger. But also talk about this when someone's married. The spousal discounts, which can be 20 to 30% on policies, stay with the policy even if someone is separated. And the shared care benefits, we touched on that, can increase her benefits without increasing her premiums at his death. So had they done this before they were separated, all of a sudden he's not really in the picture, large discounts on her policy, and as she probably is hoping that he gets hit by a truck when he ran out on her, when he does, she gets to keep his long-term care benefits. And today, some companies still are using the unisex pricing. Like everything insurance, it's not a fast-moving industry, and so the rate of to reprice policies takes a while. Some companies still have unisex pricing, and so for single females, a few companies and a few states still have that, and so it's I think it's time to look at it right now because it's not necessarily a matter of if they're going to have the gender-specific pricing in these specific states. It's just a matter of when. We move on to our third generation. So there's Carl, and he's married to Jenny, and they have one daughter, Diana. Carl works for his dad, Ben, and will take over the business in the future. And he has a good income, but no real retirement plan, and they're talking about an executive bonus plan under consideration. And Jenny is an elementary school teacher. So our July webinar is going to talk about different business uses and designs for insurance. And so for Carl and Ben, we're going to talk about protecting your small business owner clients with key person insurance, succession planning, deferred comp or deferred compensation, even DI buyout solutions. And so July's webinar will cover the CFP principal topic of insurance planning with business uses of insurance and analysis and evaluation of risk exposures. So what is a buy-sell? Well, a buy-sell is actually a contract agreement that one party agrees to buy and the other party agrees to sell at certain events. The first one we usually think about is at death, but then a close second is disability of an owner. With the life insurance policies, there's really two designs that we look at, a stock redemption or a cross purchase. With a stock redemption or entity purchase buy-sell agreement, when we have life insurance as the funding mechanism, and that's sometimes this is not crystal clear, is that the buy-sell is a separate agreement created by attorneys. The life insurance or the disability insurance is just the funding mechanism. So first you have to get the buy-sell contract in place, and then you decide how to fund it. So with the stock redemption, the corporation is the owner and beneficiary of the life insurance policy, and the corporation buys out the old owner and then retires the deceased owner's shares. With a cross-purchase agreement, the life insurance is owned by each owner on the other owner's life. So it's owned outside of the business. So they use their own money to buy out the deceased owner's estate. And the company could bonus the premiums to the other person, but it gets complicated once we have more than two owners. Because we have two owners, I own a policy on Steve, Steve owns a policy on me. Pretty simple. With three owners, owner A has to buy a policy on B and C, so that's two policies. B has to own two policies, and C has to own two policies. That's six. See where we're going with this? Two people, two policies. 3 owners, 6 policies. 4 owners, 12 policies. 5 owners, 20 policies. So entity purchase, or where the business is the owner and beneficiary, makes, especially with multiple owners, is much, much cleaner and not an administrative nightmare that having 5 owners own 4 policies on each other could be. And we have a great business life insurance document on our advisor tools on our newly revamped LLIS.com if you haven't taken a look. Now with disability, there's not just business for life insurance, there's disability concerns that come in. The first is that we're going to touch on is the business overhead expense. And in July, Kathy's going to talk about how this reimburses a small to medium-sized business owner for business expenses incurred during a disability. These are usually a short elimination policy and a short benefit period policy, usually no longer than 2 years. These are designed to cover expenses, utilities, salaries for administrative people, things that keep the doors open while the owner is rehabilitating and trying to come back to work. There's a business loan protection rider. Same idea. If the owner or primary earner or income creator is no longer there, is disabled, then this pays the loan provider from the monthly business loan obligation. Disability buyout. The BOE is generally designed to be a short-term thing. When we jump down to disability buyout, this is usually where someone's been disabled for more than 12 months. The buyout then triggers, the buy-sell agreement then triggers this event, and then the disability buyout provides a payment for the the working owner or owners to purchase the disabled owner's business interest as per that buy-sell agreement. So not just death, but a disability where one person is deemed that they need to sell. And then key person replacement. Not just necessarily the owner, but if a business has a key salesperson, a key person with any sort of specialized expertise, the business can purchase a key person replacement disability policy. So if the key person is disabled, they have their own disability policy that's paying them, but then the business receives a monthly benefit to hire, train, replace that key person. And so it provides that lump sum or monthly benefit as well. In August, we're going to talk about some hard conversations. And this involves life insurance planning for children and life insurance planning for children with special needs. So we're going to talk about why life insurance on a young child. Not necessarily a hard conversation, but if you think about the reasons to do it, then that can be a hard conversation. But how does ongoing support of a family member with special needs differ from other loved ones? These are often the hardest discussions to have, but are likely the most important conversations to have. And this month's webinar will focus on the insurance planning principle topic of the CFP with principles of risk and insurance, individual life insurance, and general principles of financial planning, with the principal topic being financial planning for special circumstances and education planning. Well, why do I own life insurance on my own children? They're 5 and 7. They don't have an income. They don't have an estate problem. They have piggy banks. But I looked at it as a way to provide, to protect their future insurability. I'm sure we all have people we know where children are diagnosed with things later in life that may make insurance hard. Or they may make lifestyle choices that make insurance difficult. And so by having insurance on small children, we're protecting that future insurability, not just by having policies, but many times with policies that allow you to increase the coverage at future points in life. It protects against loss of work. not the children's loss of work, but if something were to happen, one of my children were to die, I can't imagine how that would be and how long I may need to, it would be hard for me to come to work. So it's not income replacement for the children, obviously, but it's income replacement for me, because I can only imagine how hard that would be. There may be there would be final expenses. There may be medical expenses. On the happier side, policies can accumulate cash values, which are there to maybe be accessed for a mortgage when they're ready, college expenses when they're ready. And grandparents and grandchildren can help do this, especially with the cash values, to give their children or grandchildren a head start in life. Because Andrew thinks of all of them as his children, not just his direct children, but Andrew, being the patriarch, being well off, really wants to make sure that everyone is taken care of. And so the idea of life insurance, even all the way down to his great grandkids, is something that he's interested in. And then when we look at planning for children with special needs, many of them have normal life expectancies. And 1 in 6 U.S. children have some sort of developmental disability. And like Cameron, individuals with Down syndrome, the life expectancy many times is even to age 60. And so we have this situation where many times we think where children may not outlive parents, but with many types of special needs, children have relatively normal life expectancies, and so the planning isn't a short-term need, it really is a long-term or lifetime need for the parents. But the children may require lifetime assistance, so it's not a short thing. The largest exposure then comes what happens when both parents are gone. And in the case of Barbara, the first parent's already gone. Not deceased, he's just gone. And so Barbara is the sole means of support for Cameron. And so what happens if Barbara is not there and able to take care of all the things that Cameron requires? So in September, we're going to come back to Ben and Mary. That's a little bit about him, if you remember Ben and Mary. But Ben, again, as he's starting to, he's a successful business owner, he has key people, and he's going to touch on the benefits of different business uses of life insurance to keep and reward employees. In September, Keith is going to talk about split dollar life insurance, using life insurance as a form of golden handcuffs, deferred compensation, no load versus commission life insurance. It's Life Insurance Awareness Month in September, so break out the party hats. But in September, this is an advanced business insurance topic, and participation in July's webinar is highly recommended. And so in September, Keith will cover the CFP principal topic of insurance planning with business uses of insurance and analysis, and insurance policy and company selection. So you can use the life insurance to retain employees, some sort of golden handcuffs. As long as you stay with me X years, you get Y. If you don't, you don't. How to reward employees using split dollar and having the company pay part of the employee's life insurance. But most importantly, how to benefit the owner. Because in this case, your client is probably Ben, because Ben's the only one we've talked about. How do we benefit Ben? Helping employees, retaining employees, rewarding employees is always a good thing, but most of the time we're worried about numero uno. And so Ben wants to know, how can I use life insurance to benefit the owner, which is Ben? In October, we're moving back to the third generation. And Carl, he's 35, he works for Ben. And in this case, we're going to touch on how when there's a couple or partners, when one person has all the benefits, how do we balance and how do we right the inequities. In this case, Carl, working for Dad, has a good income, but no real benefits at work. Jenny, being a public school teacher, has all the benefits coming out everywhere. And so because the small businesses don't typically offer big benefits like public school, how do you help your clients maximize one partner's benefits, but also supplement gaps in protection, and even look at are some of the benefits that are being offered and or taken advantage of, are they actually any good? So we're going to look at Jenny's group term coverage. How does that compare to what she may be eligible for outside of the county school? Supplemental disability for Jenny. And for Carl, with no benefits, look at individual disability for him and individual term for Carl. Don't get me wrong, group term can be great. The first $50,000 of group term is tax-free when it's paid by the company or employer. That's great. Free is good. And then if an employer decides to pay for any amount over $50,000, then the employee is taxed on that amount. So they don't pay the premiums, they're just taxed on the premiums. So 1, free is good. 2, tax on premiums instead of paying premiums. Most of the time it's pretty good. Why do I say most of the time? Well, these costs increase every 5 years. And because they're a guaranteed issue versus fully underwritten, if someone's in good health, the costs may not be that great. And because these rates increase every 5 years, it's generally very inexpensive when clients are in their 20s, 30s. But as they get into their 40s and 50s, the prices jump. So it really needs to be reevaluated. And then we look at the group versus individual disability insurance. Now again, lots of times when a client has a group DI policy paid by their employer, there are some things that we might see as negatives. It may not cover their bonus or commission. If they get the benefits, it's taxable, but still somebody's paying for it. And so all of that's pretty good. So we look at supplementing a client's group disability with individual coverage that has extra benefits like multiple riders, non-taxable benefits because they're paying for it out of pocket, the ability to increase more than the 60%, the ability to include income and or bonus and commissions. So all of those things are having the group by supplementing with an individual policy is a great way to fill in any of those gaps. And then for Carl, who doesn't have the disability benefits at work, having his own DI policy gives him the best of all the policies. In November, we're going to move or touch on our third generation. We're going to touch on Claire. And she's married to Tony. They have 3 kids. They're Gen Xers. And Claire is a stay-at-home mom, and Tony is a self-employed IT consultant. And in this case, Tony and Claire, they're a blended family. At this point, they don't have any kids of their own. They're a modern-day Brady Bunch, just not with 6, and not all blonde. No, just double-check. So in November, we're going to look at insurance challenges of unusual occupations and non-working partners. And our November webinar will focus on the CFP principal topics of general principles of financial planning for special circumstances, and insurance planning with analysis and evaluation of risk exposure, DI life insurance, insurance needs analysis, insurance policy, and company selection. Whew, a lot there. But Claire and Tony, he can make a good income, but it's not predictable. He's self-employed, so he doesn't have that monthly paycheck that comes in every month. He has no retirement plan, and they have limited savings. And so they have insurance challenges, possibly looking at what can we do for stay-at-home mom and dads. Insurance challenges for self-employed consultants who don't have that steady track record of earnings. And we're going to touch on sports figures and some of their challenges and high net worth clients. How can you meet the challenge head on to help all of these different people and help them to create a plan of action? Well, we're going to look at life insurance and term layering. We're going to touch on disability insurance and how to get insurance on stay-at-home parents. Actually, they don't really stay at home. They're out and about and running all over. So non-employed spouses and critical care insurance. So why term? Why is term such a great vehicle to provide for income replacement for our families? Well, term has an expiration date, and so do lots of other things in life. Our kids at some point will not be minors anymore. Now, that doesn't mean they won't be out of the house. That doesn't mean that they're going to be off mom and dad's payroll for a while. But at some point, they will grow up and no longer be minors. Bank loans end. Our mortgages end. As long as you don't keep re-rolling it to a new 30-year mortgage. Retirement, college funding, buy-sell, student debt must be paid off. Key person. Term is great for all of these things where we can say if A, B, and C keeps happening, then the mortgage will be paid off in 20 years. The kids will be out of the house in 15 years. We plan on retiring in 30 years. So term gives us a way to tie those specific life events to life insurance, and then when we layer different term policies, it saves clients money. So as time goes on, Tony earns his income, he saves for retirement, they pay down the mortgage. So the need for future income replacement declines as they have fewer years of income to replace. Insuring a non-employed spouse, most insurance companies will match Claire for Tony dollar for dollar up to $1 million. Now, had Claire and Tony had the special needs child, may be able to get more coverage on Claire because those all of the things that parents do for special needs children are expensive if you have to pay somebody to do it. And so there may be more than that with justification, cover letters, help underwriters define a need and what somebody may need. But for a rule of thumb, a non-employed spouse can get as much coverage as the employed spouse up to $1 million. And we're going to talk about critical care insurance. In the early 80s in South Africa, a doctor realized that patients, after they survived a major surgery, they didn't recover well because they couldn't thrive due to the fact that they may have exhausted their life savings to save their life and were in serious financial debt. So that's why critical care insurance was designed, or why it was invented. But today, it's ideal for your clients who are not covered by disability insurance. Maybe they're maxed out on disability insurance, self-employed and working from home, have erratic income, no income to replace like Claire, or maybe retirees. So critical care insurance will cover the expenses that they may have as a result of that critical illness. And in one slide, how a critical care insurance policy works, it has a defined benefit amount from $10,000 all the way up to $1 million in a lump sum. And when you have or diagnosed with cancer, heart attack, stroke, any of these different things, and many more, by the way, then the policy pays a lump sum in cash so that you can recover, pay for medical expenses, pay for someone to come in, even have some of that to help with that loss of income. And I'm sure we all know at least one person who's been affected by one of these conditions. So today, 40,000 Americans will hear, you have cancer. 2,100 Americans will have a heart attack, and 2,000 Americans will have a stroke. If they'd had a critical care policy, each one of those people would have gotten a check to pay for their expenses. And in December, we wrap it all up to see how insurance minimized a family's risks, because insurance is not a one-size-fits-all product. The same way that your clients are not a one-size-fits-all client. You may have an Andrew, and the next person who walks in the door is a Claire, and then after that it may be Barbara. So not everything that will work for Andrew works for Barbara. So your clients are males and females, Gen X to boomers, business owners to stay-at-home moms, teachers to professional surfers. So we all have individual needs for protection and planning, but with the right tools and resources, you can help tailor solutions to fit all of your clients. And so what is the goal? Here's our family. Here's the greens. As we look at them, it's hard to believe that they're going to be in a soap opera all year long. They look so nice and wholesome. But behind those smiles and happy faces, there lies a web of deceit, something like that. No, not really. Just trying it for a teaser, but actually pretty nice people. So not only do we look at insurance ideas to protect children, family harmony. Here's an important one. Andrew is thinking about providing for Barbara because A, she doesn't have as much, and B, because she helped take care of Andrew's wife, her mom. Using insurance can help with family harmony just to make sure that there aren't hurt feelings. Probably more importantly is to have conversations and discussion with the family to make sure there aren't. But it's a way to create family harmony, create financial stability and protecting against losses of income, provide business continuity, and help with charitable intentions. But the reason we do it all is for the fourth generation, for Daniel, David, Diana, and Deidre. They are the ultimate beneficiaries of the family planning. And so while Andrew may look at passing assets on to Ben and Barbara, we do look at all of this planning as to see not just this generation, but the next generation and the next generation. So all of this isn't done in a vacuum. The fourth generation, and these are Andrew's great-grandchildren, so all the decisions that he's making will trickle down to them. And so as this fourth generation move through the phases of life, they're going to see what happened to their parents and grandparents and great-grandpa. And as they move through the phases of life, they will have their own insurance needs as they seek to protect against uncertainties and to deal with upturns. So, join us next month for Leaving a Public and Private Legacy, starring Andrew the Patriarch, narrated by our own patriarch, Keith Maurer, CLUFLMI, April 21st. So tune in to find out, will Andrew leave anything to his kids, or will he leave it all to the American Cheese Society? I hope everybody enjoyed that. That was fun. Dina didn't know I was going to do that, so she's sitting back here kind of giggling, kind of shaking her head. But did you know, if you haven't, go on to our new website. It's exciting. It's been months in the making. We're really excited about it. We've revamped our website with a lot of input from all of you about things you'd like to see and how it would be helpful for interaction with you and your clients. And we have a new Policy Matters, and it will be coming out within the next week or two. And hope to see many of you soon, either at the NAPFA conferences, the Garrett Retreat, the first XYPN conference, or the ACP conference, all coming later this year. And for those of you who may have not heard about us before, or this is your first time tuning into our webinars, I promise next time I won't do my movie announcer voice. Actually, I don't make that promise. That was pretty good. We do free monthly webinars. So the first thing, one of the things that makes us different from the other insurance people you may have touched base with in life are the free monthly webinars, like the Green Family Journey through the rest of 2015. But we're also not your competition. We don't do financial planning. You don't do insurance, and never the twain shall meet. But we work together to be your insurance support. We call ourselves the Advisor's Insurance Advisor because we want to help you and your clients find the best things that fit their needs. Our only clients are family advisors. We save advisors time and your clients money. We pre-underwrite to do just that, to save time when a policy application is ready to move forward, and pre-underwriting to avoid surprises in what your client will pay in premiums. We provide advisor tools and client tools on our website, and we proudly sponsor a number of different financial planning organizations. And I'm looking at the names of people who attended. I know that many of you are members of at least one of these, if not two, sometimes three. And we have product specialists in life, disability, long-term care, annuities, and the long-term care hybrids. And so it's really too much for one person to be an expert in everything, so we have multiple specialists. When your clients get insurance through LLIS, we keep you in the loop with our AIM system. So as an advisor, you aren't referring your clients into a black hole never to be heard from again. And we manage your clients' policies both now and in the future with our APE, Advanced Premium Email Notices, to let your clients know that their insurance policies, the premium is coming due. And our note systems to let clients know when they're coming to the end of their term or conversion periods. And it looks like it is 5:01. I'm happy to answer any questions if anybody would like to chime in. But at least for right now, no one's typed anything in. So I thank you all very much. I look forward to having you tune in all the rest of 2015. And thank you again.